Now I'm bringing into another section we call our interactive segment, and the question today is how can you leverage insurance for education, especially now during the transition of about, I think, grade 9 to grade 10 and junior secondary to senior secondary, lower primary to upper primary, and so forth, and so forth and so forth. And now to help us, of course, delve on that matter is David Acham. David Acham is the National Sales Manager at Kenyan Alliance Insurance Company. David Acham, welcome to the studios.
Thank you.
And my first question is, you know, there are many, of course, there are millions of learners in school today. But of course, even as they progress, so many of them continue to drop because maybe they cannot afford school fees, be it in private or public schools. And my question is, if a parent cannot afford to pay a public school, how can they be able to pay for insurance education?
Thank you, Giovanni. Thank you for having me in the studio. The country has made a tremendous effort since the introduction of free primary education. And of course, the biggest problem we have as a country is transitioning the free primary education to a high school or grade 10 that we are having as a challenge at the moment. Yeah. So to answer your question, within the insurance sector, we have a very good education product that allows parents to start accumulating funds when their children are in grade 1 or 1 year old. So that by the time their kids are transitioning to grade 10 or university, they shall have accumulated huge amount of money to be able to take care of that particular purpose.
What time are we talking about? Are we talking the timelines? Are we talking about you start saving maybe in a period of 5 years, 10 years, or can a parent come to look for insurance right now as maybe they're taking their kids to grade 10 right now? Can insurance be a solution?
At the moment, as we speak now, the insurance cannot be a solution.
Why?
The reason is that our plans and programs are leveraging from 5 years to about 25 years. The essence here is to help parents start accumulating funds for the future education of their kids, because education is the most important investment parents can give their kids. So as you take care of the normal bills of housing, clothing, and of course food, you must make sure that you start accumulating funds. You set aside a certain amount of money on regular basis for the future education of your child. So when you're in crisis, where you need about 100,000 to transition your child to grade 10 and you don't have it, at the moment, at that point in time, the insurance cannot be able to help. So the essence and where the insurance company comes in is to discipline parents to start investing in their kids' education as early as when they are 1 month old, 1 year old, 2 years old. So they have ample time to start accumulating huge amount of money for the future education of
how much?
kids.
How much are we talking about? $1 million?
We are looking at the goal the parent wants. The parents who want their kid to go to private school, the parents who want their kid to go to public school, the parents who want their kid to go to university abroad. So depending with the goal the parent have, we are able to tailor-make products for them. Our products are pretty much flexible. We are looking at parents, Mama Mboga down there, saving about 80 shillings on a daily basis, or 100 shillings, that's about 1,000 shillings every month, to a parent who is saving $500,000 or $1 million every month for the future education of them.
What? $1 million per month for education?
Depending
okay, are there parents putting that kind of money?
There could be parents who are able to put such amount of money, especially when you're looking at your child going to a university abroad to do medicine.
Yeah.
We are talking about a tuition fee accumulating up to about 78, 79 million to take care of your child in Cambridge. So for such a parent, you really need to start planning early to avoid such a scenario in future. Then there are those parents who want to take their kids to public school, especially when they're going to grade 10, especially when they're going to university, probably they'll require to accumulate about 600,000. So if you want to start accumulating 600,000 when your child is about 1 year old, then you find you set aside about 1,500, 2,000 every single month towards that. So when that time comes, then you really don't struggle.
What is the lowest amount that a parent can start saving?
We are looking at a minimum of 1,000 shillings.
1,000
going
shillings.
upwards, yeah.
And then this parent is going to save maybe for 5 years?
Yeah.
For about 5 years, 5,000 shillings, 1,000 shillings per month.
Yes.
In 5 years.
Yeah.
They'll have saved about 12,000. That is 1 year. Then 5 years, 60,000 shillings.
So I'm looking at a parent whose child is probably 1 month old.
Yeah.
When this child is going to grade 10, this child will be about 14 years old. So you can comfortably set aside 1,000 shillings for the next 14 years.
The next 14 years.
If you look at that amount of money that shall have been accumulated, then we talk about 300, 400,000.
That's a lot of money.
That's a lot of money.
Let me ask you this.
Yes.
What do? You have saved all this money.
Yes.
And then something happens. A tragedy comes, an accident, you lose this child.
Yeah.
What happens to the money?
The money basically belongs to the parent. This is just an account that belongs to the parent. By the end of the day, the money at maturity will be paid to the parent's account through check or through an EFT.
Yeah.
Yeah.
Is there some sort of interest?
So the plans are very flexible. During this particular period, the parent is saving with the organization. Of course, you also transfer the risk to the company. We talk about the disability, critical illness, accident, and of course, unfortunately, death. So you transfer all these risks that will affect your child should there be such a scenario. And basically, because of we attach a life cover to that, we guarantee that that amount of money you had anticipated to get when that time comes, then will be taken care of by the insurance company through the guardian that you shall have appointed to take care of this child.
Another scenario is maybe you've saved, say, 1 million shillings.
Yes.
And then your child has used maybe 700,000 shillings.
Yes.
So there's a remainder of 300,000 shillings.
Yes.
Are you able to get it, to access it?
So what happens is our programs and plans are very flexible. So we have a scenario where a parent wants, at that particular point in time when the policy matures, the whole amount of money transferred to his bank account. So whatever he does with that money then is at his discretion.
Yeah.
So at that point in time, probably the parent would be able to pay school fees on annual basis. We have some other programs, plans where we give money on annual basis to the parent. And the balance by the end of the period, then we transfer back to the parent's account. Yeah.
Do you have any statistics showing maybe the number of people who have partaken or that are benefiting from insurance versus the people who are not using it?
Unfortunately, the uptake is a little bit low because of awareness. As we speak now, about 14.6% have taken education policies for their kids. So there's an opportunity we have as a private sector to make sure that the awareness is really spread across the board. Because it's unfortunate that we have parents who are able to set aside 5,000, to set aside 3,000. But because of lack of awareness, they're not able to start accumulating funds for their future education of their kids. So at that point in time, should there be any eventuality of death, disability, of course, critical illness that affects their income at that point in time, then they start depending on bursaries. They start depending on Harambes, which really don't come forth. Kids have passed probably grade 9, they're not able to go to grade 10. So they start depending on well-wishers. Well, the parents at initial stage was capable of starting to accumulate funds for that future education of the child.
There's a perception out there
yes.
by larger members of the public, or rather a bigger percentage of the public, that insurance is an expensive affair, and therefore it's for the rich, it's not for the poor.
It is unfortunate. It is unfortunate perception, and it's upon the insurance as an industry to start making sure that that perception is actually not recovered in one way or the other. So the essence here is we have sales team across the board that helps us in spreading that particular gospel to that mama wamboga down there, to that person who is employed recently, so that they get to understand that the insurance company is a bit flexible, and to make sure that they start accumulating funds for their future education of their kids.
When you take a child to school, then who pays the school fees? Is it the insurance company that is, remitting this money directly to the school, or you remitting the money to the parent and then the parent pays? How does it go?
The essence of the education policies within the insurance industry is to discipline a parent to start accumulating funds for the future education of their kids. Naturally, we were never taught on how to save. We were taught how to spend money. So you find you are not able to accumulate funds on your own through some other financial streams. So if you get a vehicle that disciplines you to save within a certain period of time, then you make yourself easy to accumulate such funds. So at that point in time, when that time comes, we don't pay school fees for the parent. We transfer money to the parent or the client's account. Then the client pays school fees for their kids.
And then another scenario, I just remembered, what happens to a parent who has been, saving that money in the insurance scheme, and then maybe they have saved maybe $500,000, and then this parent has died, and then now the child is there remaining alone. The money is there with insurance. What happens to this child and the money?
Thank you for asking that question. Normally, education policies comes with the life cover attached to it, and this is where we come. We bring in a death benefit, we bring in disability benefit, we bring in critical illness benefit. So to answer your question, should a child die like now the products in Kenyan Alliance? What happens should a parent die? Unfortunately, the child depends on this parent. So the insurance comes in, where we waive any future premium. We stop that premiums from being paid, because by the end of the day, the child cannot go generate an income to pay the premiums or save the money the parent was saving previously. So what happens is we stop premiums from being paid. We waive future premium. But at that point in time, when that child is transitioning to grade 10 or university, then we avail that fund through the guardian that had been appointed by the parent to take care of the future education of that child.
Okay.
Yeah.
David Acham, thank you so much for your time. Unfortunately, we have to end that interview. David Acham is the National Sales Manager at Kenyan Alliance Insurance Company. Thank you for making the time to us.
Thank you
for educating the public out there.